There's a number that shows up everywhere in real estate right now. Sydney, Toronto, Phoenix, Manchester, doesn't matter where you look, that number is $500,000. And here's what nobody's telling you. The gap between the bank will approve you and you can actually afford this without your life falling apart is massive. We're talking financial canyon-sized massive. Today, we're running the numbers that real estate agents really don't want you to see. Not the best-case scenario math, not the if everything goes perfectly math, the real math with all the hidden costs, the psychological toll, and the actual income you need to sleep at night. Because right now, millions of people are being told they can afford homes that will financially destroy them. And the worst part? The system is designed to push you into that decision. So let's break down who can actually afford a $500,000 house in 2026, and more importantly, whether that person should. My name is Ben. I break down the real psychology of money and wealth building. If you're serious about changing how you think about money, you're in the right place. So hit subscribe and let's get started. Quick disclaimer, I'm not a financial advisor, this isn't financial advice, but I am going to show you calculations that should fundamentally change how you think about home affordability. Let's start where most people's housing dreams begin and end. 1. The down payment reality. Before we even talk about monthly payments, let's address the first massive barrier, the down payment. Traditional advice says put down 20% to avoid extra costs. On a $500,000 house, that's $100,000 cash. Let that sink in. $100,000. The median savings account in the US sits around $8,000. In the UK, it's roughly $12,000. In Canada, about 10,000 Canadian dollars. Australia is slightly better at around 15,000 Australian dollars. So we're not talking about being slightly short. We're talking about needing 10 to 12 times what most people have saved. Now, here's where the psychology gets interesting. Most people look at that gap and think, I'll just save more. So let's do that math. If you're earning the median household income, around $75,000 in the US, £35,000 in the UK, $70,000 in Canada, $90,000 in Australia, and you somehow manage to save 10% of your gross income, which is already incredibly difficult, you're saving $7,000 to $9,000 annually. At that rate, it takes 11 to 14 years to save the down payment. While you're saving, housing prices are increasing roughly 4 to 7% annually in most markets, which means the target keeps moving away from you faster than you can chase it. This is the hamster wheel. You're running as hard as you can, but the wheel is spinning backwards. So most people compromise. They put down 5 to 10% instead. And this is where the system starts extracting fees for not being wealthy enough. Welcome to PMI, Private Mortgage Insurance, or in the UK it's called Mortgage Indemnity Guarantee. Canada has CMHC insurance. Australia has LMI, Lender's Mortgage Insurance. Different names, same concept. You pay extra every month because you couldn't afford the full down payment. Typically $200 to $450 monthly, depending on your loan size and location. You're literally paying for insurance that protects the lender, not you. It's a poverty tax disguised as a financial product. Let's say you scrape together 10%, that's $50,000. Congratulations, you're starting this journey already financially depleted and now paying extra monthly fees for the privilege.
2. The real monthly cost. Now comes the part where most people drastically underestimate what home ownership actually costs. You've got your $450,000 mortgage after your 10% down payment. At current interest rates, hovering between 6 and 7.5% depending on your credit and location, your principal and interest payment lands somewhere around $2,850 to $3,100 monthly. That's just the mortgage. That's not even close to your actual housing costs. Let's add everything else. Property taxes. Depending on your location, this ranges wildly. In Texas, you might pay $12,000 annually. In California, maybe $6,000. In Canada's Ontario, around $5,000. In the UK, council tax runs £1,500 to £3,000. Let's say conservatively, $500 to $700 monthly. Home insurance? This has exploded recently. Climate change, increased claims, market volatility, insurers are pricing in risk aggressively. You're looking at $250 to $400 monthly minimum. If you're in a flood zone, fire risk area, or coastal region, potentially double that. Maintenance and repairs. Here's the one everyone forgets until it's 11 p.m. and water is pouring through your ceiling. The standard rule is 1 to 2% of your home's value annually. On $500,000, that's $5,000 to $10,000 per year, or roughly $400 to $850 monthly. And yes, some years you'll spend less, but the year you need a new roof, $15,000, new HVAC, $8,000, or foundation repair, $20,000, you'll spend way more. It averages out, but the timing is never convenient. PMI, another $200 to $450 as we discussed. HOA fees, if applicable, add $200 to $600 monthly. Let's run the conservative total. Mortgage, $2,850. Property tax, $550. Insurance, $300. Maintenance, $500. PMI, $300. Total monthly housing cost, $4,500. And that's the conservative scenario where nothing major breaks. Now, here's where the psychology really matters. This isn't like rent where you write one check. These are multiple payments, multiple due dates, multiple systems you're managing. The cognitive load alone is exhausting. 3. The income you actually need. Financial advisors traditionally say you shouldn't spend more than 28% of your gross income on housing. Banks will approve you up to 43% debt-to-income ratio. Let's reverse engineer what income supports a $4,500 monthly housing cost. At 28%, you need to earn approximately $192,000 annually. At 35%, which is already pushing it, you need $154,000 annually. At 43%, the bank's maximum, you need $125,000 annually. Now let's compare that to reality. United States, median household income is $75,000. Only about 18% of households earn $150,000 plus. United Kingdom, median household income is £35,000, $44,000. Only about 10% earn £75,000 plus. Canada, median household income is 70,000 Canadian dollars. Only about 15% earn 130,000 Canadian dollars plus. Australia, median household income is 90,000 Australian dollars. About 20% earn 150,000 Australian dollars plus. See the problem? The income required to comfortably afford a $500,000 home is earned by only 10 to 20% of households in most developed countries, which means 80 to 90% of people cannot sustainably afford what the market considers a normal home. This isn't a personal failure. This is a structural disconnect between housing prices and income reality. But here's what makes this psychologically devastating. Banks will still approve you. They'll look at your $95,000 salary, see that $4,500 is only 47% of your gross income, and approve the loan, because technically you won't default immediately. The bank's risk calculation and your quality of life are completely different equations.
4. What affordable actually looks like. Let's walk through what life actually looks like when you're approved but can't truly afford it. Meet a composite household. We'll call them the Taylor family. Combined income, $120,000 annually. That's well above median in most places. They should be comfortable, right? Let's track their money. Gross income, $120,000 per year, equals $10,000 per month. After taxes and retirement contributions, approximately $7,200 per month take-home. Now subtract that $4,500 housing cost, $2,700 remaining. For everything else in their lives, 2 car payments, they both commute, $700. Car insurance, $250. Fuel, $300. Student loans, $500. Health insurance, the portion they pay, $350. Groceries, $700. Utilities, electric, water, gas, internet, and phones, $450. Total, $3,250. Wait, they're already $550 short, and we haven't included clothing, kids' activities, medical copays, car maintenance, entertainment, savings, emergency fund. This household earning $120,000, top 25% of earners, is running a deficit on basic expenses. Here's what that feels like day to day. You check your account balance before buying groceries, not because you're being financially responsible, but because you genuinely don't know if there's enough. You avoid social invitations because dinner out means choosing between that and your kids' school supplies. You lie awake at 2 a.m. doing mental calculations. If the transmission fails, could you put $3,000 on a credit card? Could you push it to next month? What gets sacrificed? Every unexpected expense becomes a crisis. The check engine light isn't an inconvenience, it's an existential threat to your budget. This is what approved for a mortgage actually means for most people. Not comfort, not stability, financial anxiety that permeates every decision. 5. The hidden psychological costs. Here's what nobody talks about: the mental health cost of being house poor. There's research showing that financial stress affects cognitive function. When you're constantly worried about money, your brain literally has less capacity for everything else. Problem solving, creativity, patience with your kids, performance at work, all impaired. You become a worse employee because you're distracted by financial stress, which makes you more vulnerable to losing the job you desperately need to keep the house. See the vicious cycle? Your relationship suffers. Money stress is one of the top predictors of divorce. Every financial decision becomes loaded. Should we fix the fence? Isn't a practical question. It's a potential argument about priorities and whose fault it is that you can't afford basic maintenance. Your health deteriorates. You skip preventative care because the copay feels too expensive. You don't sleep well because anxiety keeps you up. Your diet suffers because you're too exhausted to cook and you can't afford healthy convenience options. And here's the cruelest part. Society tells you this is normal. Welcome to home ownership, people say when you complain about being broke. House poor is just part of adulting. No. Financial desperation shouldn't be normalized. Struggling to afford basic homeownership isn't a rite of passage, it's a symptom of a broken system. We've collectively rebranded economic anxiety as responsibility and suffering as building equity. But equity you can't access while you're drowning doesn't actually help you.
6. The system is designed to push you in. Let's talk about why this keeps happening despite the obvious math. Everyone in the transaction has an incentive for you to buy beyond your means. The bank makes money on 30 years of interest payments. They profit more when you borrow more. As long as you're unlikely to default immediately, they're happy. The real estate agent earns commission based on sale price. They make 2 to 3% of $500,000. Their incentive is to get you to buy the most expensive house possible. The seller wants the highest price. They don't care about your budget. The appraiser is paid by the transaction. Their business depends on deals closing. The mortgage broker gets paid when loans are originated. More loan, more fee. Notice who's missing from this list? Anyone whose financial success depends on you making a smart, sustainable decision. You're walking into a room where everyone profits from you overextending yourself. No one makes money when you say, "No, this doesn't work for me." The system isn't broken. It's working exactly as designed. It's just not designed for your benefit. And here's the psychological trap. You want this. You're tired of renting. You want stability. pride of ownership, a place that's yours. That emotional desire makes you vulnerable to pressure from people who know exactly how to exploit it. Interest rates might go up, buy now. Prices only go up, you'll be priced out forever. Your friends are buying, don't get left behind. These aren't facts, these are sales tactics disguised as friendly advice. 7. The actual path forward. So what do you actually do with this information? First, get honest about your numbers. Not what you wish they were, not what they might be after a promotion, what they are right now. Calculate your actual take-home pay after taxes. List every expense. Be brutal. Include the random stuff, car registration, gifts, haircuts, pet costs, everything. Then calculate what's left. That's your real housing budget. Apply the 28% rule to your gross income, but then check it against your actual take-home budget. If the math doesn't work comfortably, walk away. But Ben, that means I can't afford anything in my market. I know, and I'm sorry. But understanding reality is better than bankrupting yourself trying to fight it. Your options. Option 1, keep renting. Invest the difference between rent and what that mortgage would cost. Build wealth differently. There's no law saying you must own property. Option 2, look at different markets. Remote work has created options. Maybe $500,000 in your city, but $280,000 3 hours away. Run that math. Option 3, wait. Save aggressively. Increase your income. Be patient. The market won't stay irrational forever. Option 4, buy less house. Maybe $350,000 instead of $500,000. Smaller, older, different neighborhood. Your ego might hurt, but your bank account won't. What you cannot do is pretend the math will somehow work out through optimism and budgeting avocado toast jokes. Look, I'm not here to crush your dreams. I'm here to prevent your dreams from crushing you. A $500,000 house in 2026 requires roughly $150,000 to $190,000 in annual household income to afford comfortably. For most people, that's not reality. And that's okay. You're not failing because you're being realistic. You're not less successful because you refuse to financially drown yourself for granite countertops. The real failure would be ignoring the math, signing the papers, and spending the next decade trapped in a house you can't afford, wondering why achieving the dream feels like a nightmare. Run your numbers honestly. Make decisions based on reality, not social pressure. And remember, there's no prize for buying a house that makes you miserable. If this changed how you think about home affordability, hit subscribe and let me know in the comments what your market looks like. I read every one. See you in the next one.